Hello, 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 everyone. Welcome. We are so thrilled that you are here today. We have a really great show and a very special guest, and we'll tell you a tiny bit about what we do. We match the equity passive investor to the right syndicator sponsor in the commercial real estate, which builds and protects your financial freedom choices. And we have a great, I thought pick this out especially for Ray and his group because we love quotes that work for everyone. So it's choose victory, overcome procrastination, cheer and acknowledge yourself. If you have a dream, don't just sit there. Gather courage to believe that you can succeed and leave no stone unturned to make it a reality. And that is by a gentleman called Ruspleen. So thank you very much for coming. We have Ray. Ray, your partner decided not to join us today, I gather.
Yes, he
Okay.
is on vacation. You got your 2 days for the year. This is his 1 day for the year, you guys.
Okay, great.
A
Super.
very strict vacation policy.
Okay, so let me tell you about Ray as he'll be speaking today. Ray Heimann is a private equity professional with deep experience in acquisition strategies. In deal structuring and portfolio management. Ray began his career with J.P. Morgan Corporate and the investment banking team, focusing on U.S. REITs. He then moved to Booz and Company Corporate, an acquisition strategy desk, which is, I would think, a pretty tough position, where he advised on over 3.5 billion of corporate M&A. After that, he joined Sevrica Capital, a lower middle market private equity firm focused on driving value through deal sourcing and acquisitions, where he closed on over $750 million of acquisitions. With 10 years plus, I can't say that right, with 10 plus years in real estate, private equity, and investment banking, Ray is thrilled to be leveraging his background for Terra Capital's investors. Ray holds a BA in mathematics and philosophy from Columbia University. And Ray, we are so thrilled to have you here. Please take it away.
Thank you, Peggy, and thank you very much for having me on again. It's always a pleasure. Peggy, I think, did a good job on my whole background, so I won't bore you too much. But I am one of the co-founders of Terra Capital. We are a value-add multifamily real estate investment fund, and we do that a little bit differently than some other groups. We're really focused in the sub-institutional space, smaller properties where we can get meaningfully better returns than some of our upmarket competitors. And that's our whole thesis. And that's what I'm going to be talking about today is small multifamily. And I'll also walk through a deal that we worked on recently just to show the kind of thing that we are doing. So I will share my screen here. To start, I like to talk about just what small multifamily is. It intuitively makes sense that if you buy smaller properties, it's more difficult, and then you're going to have better returns over time. But taking a look at the U.S. multifamily housing market, small multifamily, which is defined as sub 50 unit apartment buildings, actually makes up 80% of the multifamily rental stock in the U.S. by unit count, which the first time I heard that, it kind of blew my mind. I'd already been working in smaller multifamily by that time. But it's really all of the news stories that we read and all of the major institutional Blackstones of the world are actually going after only 20% of the overall multifamily market. So it's kind of an interesting piece. And the most important thing about the way that small multifamily is broken down is that only 7% of small multifamily buildings are actually owned by institutional investors, which means that the vast majority of small multifam is owned by excellent people, but relatively unsophisticated mom and pop groups. They're very responsive to off-market outreach. They are not going to be sourcing with 8 different brokers and checking international cap rates and swap fees before landing on a price. It's a very straightforward, easy to manage, and lower price per unit world when you're dealing with less sophisticated sellers versus the larger multifamily world. Over 50 units, 41% is owned by true institutional capital, and the rest is largely owned by fairly sophisticated private equity firms and other real estate investment groups. So it's a long-winded way of saying that we're focused on a very large $5 trillion asset class, 25.5 million units in the US, but relatively low professional competition versus what 100 plus, 50 plus unit syndicators are working on. Also an excellent space to invest in. Just we've picked this underlooked part of it. And so the small multifamily space there's a reason why it's not everybody and their brother investing here. And the main reason is that it's much more difficult to work on many smaller properties instead of one large property. Many of these properties, because their existing assets are older, typically we buy anything that's 1920s to 1980s, but we have properties in our portfolio that are late 20th century. And it is also very difficult not just to find, ID, and buy them, but also to renovate them, to manage them. Really, every step of the way is a much more difficult puzzle. And what we at Terra have really focused on doing is leveraging a lot of the strategy, softwares, methodologies from single-family home aggregators and or flippers, and bringing that to the more complex, more difficult to manage small multifamily rental space to really make a scalable version of small multifamily acquisitions that can drive outsized return for our investors. And not to go through all the details, too much, but left to right here are our 4 pillars of our strategy. We buy 2 to 50 unit buildings. It's the space that's too big for flippers, too small for developers. So that's small local groups don't have the capital to take these projects down, and then larger developers, it's just too small. They have a minimum that's too high for them to be focused. So it's significantly lower competition. And we buy about 70% of our units off market, which I'm happy to talk about in more detail. That's part of what I specialize in at Terra. We renovate to top of market quality, and we're really only focused in the best neighborhoods in each market. So if you think of the new related property or large scale multifam development down the street, we're 3 blocks away in a 12 unit, 24 unit, 40 unit walk-up building that is renovated to very similar standards, and it doesn't have all of the same common area amenities, but it's also 35%, 40% lower rent. And so it hits a very important and underserved part of the rental market. Management, which I mentioned, is one of the biggest difficulties with small multifam. We've solved that by managing internally. We actually started by buying a property management company that was based out of New York. And that's a very competitive, difficult market to play in. And we brought that firm and their playbook to the Midwest, which is where we're investing now. And that has allowed us to have a real competitive edge. Additionally, it helps us deal with the complexity of managing so many smaller scattered site assets because we can define the process ourselves. We don't have to work with 10 different management companies that one only does above 5 units, one only does below. It's a different one in Indianapolis than Columbus. We don't have to worry about that as investors because we own our own management company and it's all managed through the same group. And then the last piece is in the same sense that we're taking advantage of buying sub-institutional properties and smaller properties for less per unit and having a higher yield per unit. When we buy many of them, we can aggregate them into portfolios that become large enough for institutional buyers to acquire. And so our biggest advantage at exit is that we're buying from unsophisticated sellers, adding a lot of value, and then selling into an extremely competitive, extremely hungry space for high yield multifamily. So we get a ton of arbitrage in cap rate compression by selling at the institutional level. So this is just a high level of the issues with small multifam and how we have focused on tackling them. This is pretty typical returns for folks that are in this space. I think we do a little bit better than average, and we're one of the few groups that do it at scale, at least in our geographies. But we tend to enter at an 8.3% cap rate on average. For some of the smaller down market properties, it's closer to 9%, sometimes higher than that. We hit over 2x net returns and right around the low to mid 20% on net IRR for investment for our investors. So that is an average across some of our larger projects and some of our smaller ones, but this is the returns profile that we go after. So you can see this is why small multifamily is attractive. It's more work, but our returns profile is very strong. So we're focused on going after that. And then the last thing about small multifam that I want to talk about a little bit is geographical focus. I think across, this whole picture across the whole US here, there is a lot of opportunity for small multifam. What's true in one market is true in many. What we've found is that because there's so much value to be mined in buying off-market properties and adding 20 to 30% of total development costs and renovations, we like to stick in markets that are less risky. So what we want to do is drive the outsized returns, but do it in less risky places, really drive beta. And we've picked the Midwest as a great place to do that. I'm actually from Cleveland originally, so there's maybe some bias in our selection, but we're very mathematically focused, and we actually do not invest in Cleveland. So if there's for the avoidance of doubt, if I was truly biased, we would. But we're really focused in Pittsburgh, Columbus, and Indianapolis. So Pennsylvania, Ohio, and Indiana. These are specifically markets that have little institutional competition, more so than a lot of other markets where there's small multifam competition, like in New York. The yields are very high. We say here 2.5 percentage points higher than in other markets. It can be 3 or 4 percentage points higher than some of the coastal markets like San Francisco and New York, or even more. It's just a much higher yield, which lends a lot of risk protection as well as returns enhancement. But there are a couple other things that are really important about these markets. They have really strong job markets, post Rust Belt issues from the 80s. These are the markets that have really come back strong with education, healthcare, and medium and low cost location services jobs that are just very bedrock, recession resilient, did well through 2007, 2008 financial crisis versus other cities. That's the type of market that we like to be in, and not, roll the dice on some of the riskier, higher growth markets with more competition. Also, in these areas, the assets are 20 plus years behind on CapEx, which is great for us as value adders. And it have much better regulatory environments versus some of the tighter regulated markets like New York City, where we still have a fairly large portfolio, both on the management and owned side of things. And they also have much better affordability. So in our markets, average rent is 25% or lower of the average median income, which is great for many reasons. It means that there's room for rents to go up. There's lower regulatory risk from renters. The list goes on. But that is an important metric that we really like to focus on. Our portfolio in New York City, for instance, is closer to 48% of average median income is paid every year in rent. So it's, almost half of your income goes toward rent payment versus, less than a fourth of it in our market. So that's important to us. So that is a high level of where we're focused and why we're focused on that part of the market. I want to walk quickly through an example of a deal. This one, we actually are still raising for it, but it's 80 or 85% spoken for already. There's still a few $100,000 of open space. So if folks are interested, happy to share more information after the call. But this is a 38 unit property, so it's sub 50 units. It's right in our wheelhouse. It's got the same return profile as everything else we look at. It has a nice 10% coupon post renovation, quarterly cash flow distribution. So unlike other deals that are your money goes away and then you hope it comes back after 5 years, our projects have a quarterly distribution. And we spend fairly significant percentage of our total spend per door on this project is going to be in renovation. So it's pretty meaningful value add, hyper core location, recession resilient market. This is in Indianapolis. And it's a strong value add. So it's right on our metrics. It's exactly what we look for in a project. We don't have to go through all these details, but it's largely 1 bed, 1 bath, and then 10 2-bed, 2-bath units, which when you're going after that early 20s to early 30s rental demographic is ideal. It's fewer families than you would see in other areas. And so it makes sense to have slightly smaller units, and the rent per square foot is extremely high for those unit cuts. So that's another thing that we look for in a deal is if it's going to be next to or in a city that it's a good rental because there is excellent school district, then having 3 or 4 bed units is ideal. If it's not, it makes more sense to have smaller units. So there needs to be a thematic approach as well. And then we're very sensitive to parking. Everyone in the Midwest is a driver, and you need to have parking. Not all multifamily value add projects do. We pay a premium when they do. This one's great because it is 45 outdoor spaces. We're actually planning to turn it into 65 by doing sideways cuts. So there'll be, enough spaces for every single resident. And this is a 1928 build. So it needs love, but it doesn't have structural issues. And it is 15, 20 years behind on interior renovations. And so it's a place where we can actually add some value and create a product that's better than what we're coming in with. Indianapolis is a great example of what we look for in a city. Just over 2 million population in the MSA. It is, number 1, number 6, number 8 for this and that, good place to live and all those types of things. It's a, nice area in the Midwest to be located. But what we're most focused on is that it's really the economy is built on the bedrock of recession resilient, long-term growth industries. So life sciences, healthcare. It's a massive hub for insurance and financial services, which, New York City has a KPMG and Indianapolis has a KPMG. They're both great. Indianapolis is a medium and low cost location. So in a recession, they're sort of the last to be laid off. And so it just makes it a significantly more recession resilient market. And then it has some other essential services, logistics hub. There's a large Indiana Amazon hub just outside the city. And of course, because capital has a lot of government jobs in there as well. And this on the right is really illustrative. I mean, this is 1 month out of the last 48 months where it's performed in the top 10 on year-over-year rent growth, but it shows the supply constrained nature of this market where, in this particular month, it outpaced Miami and Orlando in year-over-year rent growth. And it's really the factor of there's very little large-scale multifamily development. This market doesn't suffer from the same high-risk, 2,000 units coming online in the next couple of years. It's more like less than 400 that are, luxury units that will come on over the horizon here. So it's exactly what we look for in a market, very similar to Columbus and Pittsburgh as well. Within the market, you can see this large outer loop. That's Indianapolis proper. We have properties throughout this entire area. I think the last time we were on Nest Egg, actually, we were talking about a property in Beech Grove in the southeast there, which we acquired and are very close to being done with renovations, and it is meaningfully outperformed. It's actually been a very good project for us. It was 60 units. And but this is even more core located. Beech Grove's a great neighborhood, but this is right in the inner loop of Indianapolis and is a close drive time to all the major employment centers and the nightlife, good restaurants, so on and so forth. We really pay attention to location when making selections, but as you can see, this is within the inner highway loop. It is walking distance to a IU health campus from the larger health systems in Indianapolis. It's close to the IU Health HQ. It's also close to the IUPUI and IU Health campuses for education. So it's the nursing school that's over there in the western part of the screen. And it's close to the city center, all that, but it is close without being directly on the main strip for food, bars. The good movie theaters are over there. The cultural landmarks are over there. It's kind of the happening hip strip in Indianapolis. So it's, very, very much so walking distance, less than a 5 minute drive to that, without being right on top of it. So it's just a very good mix of proximity, but also distance from the loud part of the city, which Midwesterners appreciate. And that is really the long and short of what we want to find in a good deal. We will close this deal over the next 45 days. We will take 20 months to complete renovations, including the having existing residents move out, and we will be fully leased up by the summer of 2025 and cash flowing all the way along. And we'll self-manage that property without any need for on-site staff. It's sub 50 units. It's one of the nice things about the small multifam space is that you don't require on-site staff for the vast majority of projects. And it'll be a very nice, corely located asset for us. And so we're very excited for that. But it showed here as an example of what types of projects we're really focused on. And this is right in our wheelhouse, well located, good city, just the exact type of product that we can add tremendous amount of value to. And so that in a nutshell is Terra Capital's strategy and focus. I will drop off there, and any questions that you all have, I am happy to answer, whether that's strategic or deal related. I think you may be on mute, Peggy.
Peggy, you're on mute.
You're on mute.
Thank you very much for your presentation. It was really great, and I have a few questions. And if you would close that out, that would be great.
You got it.
Thank you, Ray, very much. So is this part of your fund that you have?
So that's a good question. Yeah, it's a good question. So we acquire 20 units and below in a fund, and then our 20 to 50 units we do as syndications. Occasionally we'll do slightly larger. So I think I talked about it, a 60 unit project that we did in Indianapolis. We're working on a 64 unit one in Pittsburgh right now. Those will also be syndications. But for the smaller properties, we have a 506c fund that is purely discretionary. It allows us to move quickly, and it's a sort of a different asset class, similar strategy, but the farther down market, the quicker you need to move, and the lower the sophistication. So we do those through a fund. This one that we just showed would be a syndication, so it'd be separate and outside of that.
Okay. And then what do you do? Do you keep these? What's the overall plan? Because you've got the fund. Are you keeping those? Are you flipping those? Are you when you find a good property and you're able to make it cash flow well, because if you're buying it at 8 or 9 cap, by the time you get it ready to roll, it should be up at about 11 or 12 cap.
Yeah.
Are you holding these?
Yeah. So what we do is we have everything on a 5-year hold period. At the end of that 5 years, we open up to a third-party process for a sale. If after that process, at the best offer, we're still buyers, then we will roll those assets into our core fund, which allows existing investors to also roll over if they want to take some of their proceeds into a long-term annuity structure vehicle. Occasionally, probably about half the time, maybe a little bit more than that, when we go to do an exit, the third-party process yields an offer that is higher than where we would want to continue investing. And so at that point, we will take that exit and leave. And so it's about 50-50, depending on how the market reacts to our exit product. We will either roll into the core fund and keep it or sell it. We love to keep it if we can. We manage a lot of these properties ourselves. we are heavily invested ourselves. We're anywhere from 5 to 15% of the equity in any of our projects. So for us, we would also like to be long-term holders of the product, but it just depends.
What about in the fund? How do you treat that?
The fund works similarly. We don't sell anything during the hold period. So during the 5 years from commitment of capital to the return of capital, we don't sell anything. We're only acquiring, renovating, leasing, and holding and managing.
Mm-hmm.
At the end of that 5 year period, same deal. We will go to a third-party broker process. There's a very hungry and surprisingly large market for fully renovated portfolios, especially in the Midwest, just because there's so few over 100 unit properties to buy, that the scarcity brings a lot of institutional groups and private equity firms to the portfolio space. And so if there's a group there through that process that wants to buy at a 5 3/4 cap rate at exit, then it's hard to say no to that. But if the prevailing offer is 6.5%, then we might be buyers at that rate. So same situation where we just take a look case by case, and if we're a buyer, we'll stay. If not, we'll exit.
Well, you have to look at whatever the going interest rate is to determine your cap rate. So we don't know where that's going to be in 5 years, unfortunately.
Exactly. Yep.
Okay.
Very true.
So I don't know, when you have a good deal, let's say this 48 unit really turns out to be, why is it that you let the property go? Why don't you just keep it? Do a refi, pay your investors their money out, their capital out, and keep them in and build your retirement, so to speak.
We do have investors that do that. So we have probably about 500 units of long-term hold properties that, if the market looks good, we go to our primary investor and we say, hey, now it could be a good time to exit. And they say, no, we want to keep taking the cash flow, so we're going to do that. Typically, our investors do prefer, though, to have an exit and have a cash flow event, which is the reason that we do it. If we could engineer it so that everything was an evergreen fund, we would love to do that. It's just that the vast majority of our investor capital comes from family offices and fund of funds, probably 70% of it. And with a few notable exceptions, they are generally 5-year hold investors. And after that 5 year, they want a new investment vehicle that they can invest alongside with us. Sometimes they want to participate in the long-term annuity structure, but generally they want us to continue generating over 20% net IRR returns for them with a new fund, a new syndication, so on and so forth. And it's just a way for them to keep their return structure higher. And some of them take advantage of a 1031 as well, if they're a high enough percentage of the ownership stack.
So can you come in as a tick so that you can take advantage of the 1031?
We do not do tick structures typically. In the majority of our syndications, we'll have one investor that's 60-70% of the equity. And in that case, that investor can usually take advantage of the 1031. For folks that are smaller portions of it than that, it can be more difficult. So we typically have a long tail of non-1031 participants. But it really depends on the product. And in some cases, we have investors that are only, let's say $500,000, $600,000 with us, and it's in a small portfolio, and that's their whole participation, and it's a 1031, and they might hold for 5 years, 7 years, 9 years. It's up to them. But whenever they decide to exit, we'll help them facilitate the 1031. We do a lot of that. Especially because coming from coastal markets to the Midwest, there's some advantage to go upsize on that. Without getting into the details of 1031, they can buy a similar or larger asset with their 1031 cash, which is not always available to them if they stay in the same market.
Great. Thank you very much. Jana.
Thank you. Ray, good to see you again. So you've got an average of an 8.3 cap rate. What's the banking environment? Is it on small multifamily? Is it similar to the large multifamily, or does it vary, and how so?
Yeah, that's a really good question. So for small multifamily, we qualify for local and regional bank mortgages, which tend to be very attractive, especially in the last 18 months, because they lag the rest of the financial industry in raising rates. So right now, we are usually looking at a 6.5% interest rate on our local product, which we think is very competitive. For the remainder of 2024 and into 2025, I wouldn't expect it to go crazy lower than that, with locals and regionals. And before interest rates started going up, locals and regionals were more expensive than national debt. So it all depends on where you're going. But for the most part, you have everything available to you. There's even a portfolio product for Fannie Freddie that we have taken advantage of before.
Okay, and then I want to circle back to some of your conversation with Peggy. So you have a fund of small, let's say under 20s. You'd syndicate between 20 and 50 or slightly bigger than that, and then you have
Exactly.
this core fund that kind of piqued my interest, and that's long hold. What can you tell us about the core fund and the kind of, do people hold that for cash flow, or who might be the ideal investor for a core fund? I've not heard of this before, so I'm curious.
Yeah.
And
So
is it a fund, or is it a one-off, or how is
so
it
it actually
different?
it actually is a rolling close fund that it includes various assets that we have exited over the last 10 years. Everyone in our core fund is a investor in one of our 5-year hold funds or syndication, and they are in the core fund because they've rolled over. So they took some of their exit proceeds and converted it into shares in the core fund. And the valuation is based on whenever there is an entry into the core fund with rolling assets into it, there's a two-way valuation of the incoming asset and the existing assets to determine the value and how much shares incoming investors get. We have never sold an existing position in the core fund to a third party that wasn't from an existing investment before, but it is possible, and other core funds have that aspect to it. But yes, it's groups that are looking for long-term cash flow. It is fairly illiquid because we and or they would find a buyer for their shares whenever they wanted to exit. So it's not a great hop on, hop off tour bus structure deal, but if somebody's really looking for long-term cash flow, it can be good. And I think the common thread is that groups who started to really like the monthly and quarterly cash flow distributions and didn't want to stop that after exit rolled into the core fund just because it's a nice feature for them. Might be more psychological than financial, but as we all know on this call, I think those two things are frequently actually the same thing.
Thank you. I think you muted yourself, Jonna.
Why'd I do that? When a property moves from, let's say a syndication, you decide at exit you're going to put it in the core fund instead of sell it. Say it's a great cash flower and the market's not great, and you flow in there. Is that a sale to the core fund? And does the depreciation does the depreciation start again? The cash flows, how sheltered are they with depreciation or other deductions?
Yeah, so the way that it works from a corporate org structure perspective is it's actually the LLC that owns the existing investment is purchased by the core funds LLC. So frequently it's a direct real estate property transaction, which is important in our markets for a number of reasons. So it doesn't reset property taxes and things like that. So, and it's also a more tax efficient structure for LPs. Frankly, I'm not an expert on tax law in that area, but the cash flows are protected. There is not a massive event, and it does count against your capital gains from the original transaction. So if you made $100 worth of value and you rolled 50 over, you only have to pay your capital gains at the moment for the 50 that you actually took home. The rest is cash that stays invested in your, as an asset. So it can be a capital efficient way to continue participating and get your original principal back.
It's a very interesting structure. Anything else, Jonna? Because Clarence has a question. I knew you would, Clarence.
No, but he's got me curious now.
Well, because that's why we're here, is to learn. Clarence.
Hello.
Hello.
Hey there.
So if you are one of the investors and you're in a property 5 years and then you decide to roll it into or move it into your core fund, and I'm not sure how you do that. And the 5 year, well, one of the investors that's been with you in that property, do they have the option to do that at their basis, or is the property jumped up? Are you buying it at a higher price? How's that work?
Yeah, the price and the new basis will be set by the third party market process. So if if the best offer that we had was for $3 million, then effectively the core fund will buy that property for $3 million.
All right.
And so, yeah, go ahead.
And what say does the investor have in that? I mean, maybe an investor is in a property that's operating good for them. They would prefer to stay there. You guys are going to take it into another entity that you own. What happens to that investor?
So that investor can decide to stay at the value in the core fund, or they can exit altogether if they wanted to. We have structures with certain investors where they don't want that at all. And especially when they're the sole investor, they can drive the car on their exit timing. So if they want to exit earlier or later or never, that's totally up to them. Our typical structure is the one where at the exit, the investor can decide whether they want to roll over and continue or take their chips off the table. That deal that we were just talking about, the 101, that is that typical structure. And one investor is 60% of the equity check. Another one is just over 20% of the equity check. And they're aligned on that possibility. They also are aware of the fact that we might get a good third party offer that, we won't roll because we're going to take the highest price. So it's really case by case, but that's our normal.
So I think what Clarence is asking is, if I'm the investor and I want to stay and you move it into the core and you it's now worth $4 million, what's my position as the investor when you decide to sell this down the line? What's the tax thing? Is that, Clarence, kind of what you were getting at?
Yeah, well, thanks, Peggy. It is sort of that, but more importantly, let's say an investor has $500,000 in, and they like the way this thing's been operating. But now, to maintain their position, maybe the property's doubled in value. So there's $1 million. So there are expenses, there's transaction cost. The sponsors are entitled to part of the upside. And I'm just wondering, does the investor have to add money to stay in the same property in the new entity? And the same thing you're asking, Peggy. I mean, there's just a lot of aspects to it, and I'm a bit confused by all of them.
Yeah, no, it's a fairly complex process to go through the rollover, but investors never have to put in additional capital to maintain their position, which is some of the pieces that's nice of it. If investors are interested exclusively in a longer term hold, or they want to have full control over the asset, I always would recommend doing a syndication one-off with us, especially if they are in a position to write the full check for not all of the equity stack, but the majority of it. That way they can be in the driver's seat however they want to go. And there's still option to roll into the core fund if they want to. Otherwise, it tends to be the lead investors kind of decision making. We vote always on a percentage basis. So if somebody is 70-80% of the deal, then that's typically how it'll go.
Okay, great. Anything else, Clarence?
Yes, you mentioned capital stack, and I apologize for missing the first 10 minutes of the call, and I don't want you to go over anything that you've already gone over because I can view it. But did you discuss the typical capital stack and the fees and when they're taken and how they're taken and all that?
I did not. So I'm glad that you brought that up. And now that you say it, I realize that I should have. But we are a very standard 2 and 20 approach. So we have a 2% management fee, and then we have a 80-20 promote structure at exit. We have a pref, which is at 7.
Is that a management? Okay, that's like an asset management fee. It's like a hedge fund.
Correct. It's a capital management. It's not property management, separate from that.
Okay. Now, is this also in your syndications?
Yes.
So once an investor has put in $1 million or whatever, and that goes from year to year, and you've got the asset, I mean, you've got a structured asset where you're trying to develop this property, and in 5 or 10 years it doubles in value, you sell. Okay, all along the way, there's 2% of the total asset value or the total contribution by all the investors, correct?
Correct. And that's offset by a 23% IRR, which is already net of that fee.
Well, that's in the future, correct?
Yes, that includes the exit. Correct.
Okay, so that's speculative. I mean, that's projected.
It's projected.
So we don't know what the IRR is going to be, but we know that the 2% is continuous, and that's up front.
That is correct. Yep. And then on top of that, there is a 7.5% preference. So if the asset is underperforming, then the manager, us, we get no upside at the end, aside from our pari passu equity. So if we don't hit at least a 7.5% year-over-year compounding return, then we don't get to participate in a promote structure.
Okay, but that 7.5% preferred, is that after the 2% management fee?
That is after the 2% management fee, yes.
Okay, so who's really preferred?
LPs. The only people that are not preferred is me.
Well, if you're getting the 2% up front, it sounds to me like you're preferred.
Well, there is that there is a preference, yes, but we don't actually participate in the preferred hurdle. So we get negatively affected by performance that goes below that lower bound.
What type of acquisition fees do you charge?
We do 1% on purchase price. And then depending on the level of renovation, we do anywhere from 2 to 5% on construction management. And that is it for fees.
Thank you.
Yep.
Thank you, Clarence. Mr. Beckles.
Thank you for the presentation. My question is about exits. You had a chart up front that talked about exit strategy. My question is about, as historically, how have you performed with respect to exits historically?
Yeah.
Or was that chart I think I put a question in the chat, was that chart in the beginning? Is that your expectation? And what I'm really curious about is how have you performed historically with regards to exits?
Yes. So that chart is our expectation. So that's our target performance. It is based on our past performance. So we have had 5 round trip exits, and we have a whole separate case study piece for it. Some of them have been in New York City. And so instead of it being a 2.1x, it's more like a 1.9x. It's just a tighter market. It's one of the reasons why we're in the Midwest in the first place. But we do have 5 total round trip exits. They've all performed similarly. They're also all the same asset type. The largest individual property that we've ever exited was 20 units. So, everything else has been smaller, and then all of our syndications, we still manage them.
Thank you.
Is that it?
Mhm.
So Paul asked about how many exits you've had, which you just said, in your syndication, and how long is your average exit, which I don't understand what a length of.
The hold period, I assume, is what that is. It is always 5 years. 2 of the 5 were 7-year holds, and that was not our choice. It was our investor's choice to do it that way. Also good. I see syndications that are anywhere from 3 to 7-year holds, and sometimes they're longer than that or shorter than that. But usually in that 3 to 7-year window is where I see those going. Ours, we always try to hit 5 and just be standard, kind of middle of the fairway.
And Eugene, did you see the markets that they're in? The 3 markets?
Yeah, I put that in the chat very early, so he's answered that question.
Oh,
Yeah.
okay, good. Okay, just wanted to make sure everybody got their questions answered. So this is a really nice syndication, this particular one. Very
Yes.
different than the fund you've got going.
Yes, it's very different from the fund. A similar location. Some of our syndications have been workforce housing. That one in Beech Grove that we were talking about, whatever that was a couple months ago when we were on here, was more workforce housing. So we do some of that product as well. But we have not gone into the affordable housing space. So it's really just kind of been affordable housing up to this, just immediately sub-institutional quality product. And that's really the part of the market we see as the most underserved. And so that's where we want to continue going for at least the medium term here.
And is your fund still open?
It is. So our second fund is still open. We have raised, it's open because we hit our cap and then we decided to expand it. So that fund is still open. We are also getting started on our next fund, which will be the exact same strategy, but with a few additional geographies. And that I would not expect to launch before 2Q of 2025. Just kind of a long process to get that launched. But our current fund is open. There is still, it's a $30 million fund. There's still somewhere between $5 and $8 million of unspoken for commitments, and that one has been mostly family offices that have been in there, and we have 2 anchor groups that are fund to funds groups that hopefully will be anchors for our fund 3 as well.
That's great. Congratulations on how well you're doing. It's really terrific.
Thank you. I appreciate
So
it.
Michael, any chance you might have a question? Or Jeff, you're in this business. You might have a question. Karen, you have a question? You do shake your head a lot. So it's coming in, right? Coming into your head? Good. Patricia, anybody else? Fred? No, nothing this time, huh? Okay. It's all right. As long as you're happy with what you've heard and you've got he's answered all your questions, that's really great. It's really great.
Also, more than happy to discuss offline in greater detail. I think especially Clarence's questions show that there's a lot more detail to investing in any of these things, whether it's syndication or the fund. So we're more than happy to go through it in detail, and we always enjoy having new investors along, but also folks that have a operational background. We've met through you all as well, and have been great connections. So more than happy to discuss.
Yep. Well, anybody's welcome to connect with us. David, I knew you wouldn't fail me.
Hi, Peggy. Yeah, I have a question.
This is Ray. Ray, this is David.
David, good to meet you.
Good to meet you. Hey, I had a question reference to the management. I kind of came on late. Apologize on that. So on the management part of it, who's director of that, and then also who's managing the remodeling of your CapEx or whatever?
Yeah, those are two great questions that I did not talk about. So again, thank you for reminding me to give competent baseline important data about what we do. But yeah, so on the property management side, we bought a property management company many years ago, almost 10 years ago now, based out of New York City. We've expanded them to the Midwest, and so they run all of our property management. That is important because it's really hard to find good property managers, especially in these markets and for sub-institutional sized units. And they're very expensive. So we charge through that firm, we charge a 6% property management fee. Market is more like 10%. And there are some, if you wanted to get kind of the best manager in market, it could be closer to 12%, depending on the city. So it's important that we do that. Plus, we have more control, and we're obviously more bottom line focused than a property manager third party would be, because they really only care about collecting their fee as a percentage of rent. For us, we're managing for our returns expectations. So there is a network of boots on the ground folks and property managers that specialize in each of our 3 cities, actually 4, including New York. They are market specific resources, and we have a good amount of truly third party management contracts with them as well. So completely separate landlords that have no affiliation with us that we manage for. And so that's the property management side of things. And then on the construction management side, we have also market specific acquisitions analysts that are really vertically integrated, and they help close the deal, they help underwrite the deal, and they manage the actual construction process. They are overseen directly by my partner, Tom, who is not on the call today, unfortunately, but he is a dynamo of construction management and development. He's developed and renovated over 2,500 units in his career. He spent time with the Rose family in New York, developing a lot of, pretty major headline properties like the old AIG headquarters in New York City. He's done a lot of ground up development in the Midwest and non-core urban infill areas of the Northeast. So extremely relevant experience. And it's one of the most difficult and complex parts of our business, is to successfully manage so many renovation projects and so many contractors at once. And he has developed a genius system for doing that constantly has new contractors being tested out, and then long-term relationships built with those people so that we can keep growing their business alongside ours. And it was probably the piece that we were most concerned about as we expand into new markets, but it just is, there's bumps along the road for sure, but it's just worked out extremely well for us. When we started and we were in New York City, we had 2 contractor groups that were fantastic, and we were worried that that was a one-off and we weren't going to be able to replicate good relationships like that in other cities. But we were, not without considerable amount of effort, but that side of things is going well. So that's how we manage property management, but also our construction management, which is all internal. We don't have a third-party construction manager that we let them run away with the deal. We're very hands-on.
All right, thank you. Also, is this a historic property?
This has it is not quite an historic property, but that street has an historic protection on the facade. Luckily, the facade's in very good shape, and we're allowed as of right to restore to existing conditions. So we can do pointing and some brickwork, and we can touch up the sills and panes. But it has a lot of the streets in downtown Indianapolis have the same thing, where I can't paint it yellow, but I don't have to have historical approval to renovate the interior, for instance. It's just external.
Okay.
It's
Thank
great.
you.
Yeah, and I bet you have a lot of good pointers there in that area.
Dealing with the various historical groups around the Midwest and in New York has been a pretty incredible experience. The LPC in New York City, which is the Landmarks Protection Committee, is extremely specific, and they're doing important work. I mean, they're maintaining the authenticity of important historical assets, but it causes you to have to go through a lot of hoops just to replace broken flooring in units that desperately need it. So it can be a headache, but it's all important part of the ecosystem.
Great.
Very
And
expensive too. So
Yeah.
Extremely. Yep.
That too. Clarence has another question. We're right at the coming up to the top of the hour. So last question.
Did you say you offered a preferred return?
Yes, 7.5%.
And when does that start?
Day one.
So day one of the closing of the property or putting your money in, or?
For syndications, it's day one of the closing of the property. For the fund, if you contribute all of your committed capital day one, then it's the same thing. It's just that as soon as you send in your capital, that's when it starts. If you are on a draw schedule, where typically we draw over anywhere from 4 to 6 quarters, and that's usually for groups that have brought in at least $1 million. Groups below that tend to not want to do it that way. It's just simpler, but it's really up to them, and we have full discretion in our fund structure. For them, the 7.5% pref starts accruing when you've actually contributed capital, when there's actually been a capital call.
Is there a what happens if the property doesn't cash flow sufficient to pay that out?
So we keep a very large reserve to make sure that happens. And really, it's only during the first 12 to 20 months at most where there is any type of constriction there, just because units are under renovation and so they're not cash flowing. We keep a reserve for that time so that problem doesn't happen. If it were to happen, in theory, frankly, I would have to look at our fund docs to see how, or rather our syndication docs to see how that mechanism works, because we've never had it before. I would assume it's at LP discretion whether we stop disbursements or have capital called to cover. I just have to check. We haven't run into that problem before, and those docs are a little older from our first syndications.
So what's the first distribution?
So the first distribution for this project that we're working on now will be after the first quarter where we're operating. It's already has
After first quarter. Okay.
Yeah, it already has I think it's 45% occupied or something like that. So it already has cash flow. We would turn the first slate of units in 3 months' time, and those would be leased up. We're actually, one of the reasons why we're so excited about this one is because those units will be ready for early summer renting period, which is a lot of rental seasonality, especially in the Midwest. And so we're going to hit right at the right time in late May to early July. So it should be a case study. We're hoping for it.
Great. Congratulations. And thank you very, very much for your presentation. We're so happy you came and talked about this particular property and the education that you offered everyone. We do appreciate it, and we hope you come back again.
Excellent. Well, thank you very much for having me. I really appreciate it. It's always a pleasure to be on, and I would very much so welcome the opportunity to come back later.
Okay, great. Thank you.
Thank you.